APRA has just dropped a massive announcement, one that is already making headlines, rattling investors, and sparking panic across the property world. And if you own a property, want to own one, or if you're trying to build a portfolio of property for an early retirement and financial freedom, this is something you need to hear and understand. APRA, Australia's banking regulator, this is the body that literally controls how much money Australia can borrow, has announced a crackdown on what it calls high-risk property loans, specifically targeting investors who want to build a large portfolio and who take on large amounts of debt to buy multiple properties. They came out and said, we are cracking down on risky home loans. If you are a homeowner or an investor, you see that and you think, great, first it was inflation, then there's talk of rate hikes, land tax. Now the regulator is coming for my borrowing power as well. APRA has now said if your total debt is more than 6 times your income, you are officially in the high risk bucket. And banks can only do so many of these loans. Sounds scary, right? But here is the thing. There are so many caveats in this policy that the headline and the reality are actually two very different stories. In this video, I'm going to break down in simple language what APRA has actually announced, who this really hits, who it hurts, what it means for people trying to build a portfolio property for financial freedom, and most importantly, what it means for prices over the next few years. Because I can tell you now, the way this is being sold in the media is not how it actually plays out on the ground. So stay with me. By the end of this video, you will know whether this changes your game plan at all and whether this is just more noise in a very noisy market. This is why I do these videos. This is your 5 to 7 minute update every single day on the property market, your daily property update, so that you can be a property insider. Make sure to hit the subscribe button so you never miss one of these videos. Let's decode this properly. From February, APRA is telling banks, of all new loans you issue, only 20% can be what it calls a high DTI, debt to income ratio, meaning the borrower's total debt is 6 times their income or more, and that only 20% of their loans can be to people that are actually in that 20% bucket. Now, this cap is split into 2 buckets. There's a bucket for owner occupiers, and there's also a separate bucket for investors, so it's measured separately. Now, here's the part the headlines completely skipped. This rule only applies to existing properties. It does not apply to loans on new builds, new construction, off the plan. It doesn't apply to those loans. APRA actually carved out and took out off the plan new construction, new dwellings, new supply housing, and also owner-occupier bridging loans. These do not count toward the cap. Why is this so? Because the government is desperate for more supply, and they're not going to punish investors who are helping to build it. This rule sounds powerful, but when you look at the numbers, it's tiny. APRA published the current stats. Only 4% of owner-occupiers and only 10% of investors are above the 6x income today. The limit is actually 20%, so there's a lot of room to play with there. We're nowhere near the cap, not even close. This is like banning people over 8 feet tall from entering a restaurant. It sounds dramatic, but basically nobody is that tall. This affects hardly anyone. The real limiter has always been APRA's 3% buffer. Right now, if your rate is 5.5%, the bank pretends it is 8.5% when calculating your borrowing power. That alone knocks out highly leveraged investors, it knocks out people trying to stretch to multiple properties, and it knocks out buyers trying to push above that 6x income. The buffer already does 90% of the work. The new DTI cap does the final 10% at best. So when the media says APRA cracks down on investors, it's really not true. This rule hits one small group, investors stacking multiple established properties with very high leverage in a very short space of time. That's it. It doesn't really affect first-time buyers, it doesn't affect upgraders, it doesn't affect anyone wanting to build new supply or add new supply into the market. This is the jaw dropper. If you're buying new stock off the plan, new construction, new estates, APRA is not touching you. You are exempt. Your loan doesn't go into the DTI cap. Your bank doesn't get penalized and your borrowing ability is unchanged. This is a gigantic green light from APRA for investors who help to build new supply. Now let's talk about what everyone actually wants to know. Does this slow the market? Does it cool prices? Does it hit 2026 or 2027? No. Here's why. Investor demand is rising. In fact, we are at record levels with a 40 billion increase in investor lending last quarter. Migration is still extremely high. Rental vacancy is still at historic lows. The 5% deposit scheme is turbocharging entry-level demand. Rate cuts are still expected in 2026, and new supply is lagging by years. This rule is far too soft to change the market. At best, it slightly taps the brakes on the most extreme borrowers. But prices are still being driven by supply, by migration, by rates, and by demand, not by a DTI cap that banks aren't even close to hitting. Ultimately, what does this mean for you? If you're a homeowner, your loan is safe, nothing changes. If you're a first home buyer, you can still borrow above 6x income if your bank approves it. Most lenders are nowhere near the cap. You should not be impacted at all. If you're an investor buying new property, you are exempt, you are not affected. If you're an investor stacking existing houses with high debt, you may feel this. Banks are going to scrutinize you a lot more and may in fact reject your loan. For everyone else, this is just noise, not a market mover, not a market changer. That's your daily property update. Fast starter so you can be a property insider. Make sure to hit like, hit subscribe, and drop a comment. Should APRA go harder on high debt investors? Or is this already too much? I'd love to hear your thoughts and opinions.